Welcome to Coldstream Investment Strategy Group's quarterly call summarizing the third quarter of 2016. My name is Howard Coleman. I am the Chief Investment Officer of Coldstream, and with me today is Darren Ritchie, the Portfolio Manager for Joe Cervantes' team. I will be providing a market recap, and Darren will present our two special topics, which for this call include a brief election update and a look at the reinsurance market, as many of you have an investment in one of Stoneridge's reinsurance funds. For this call, there is a box on your screen where you can type in any question you might have. We will try to address your questions today, but if we do not get to them, please contact your relationship manager or your portfolio manager with your question. While we have scheduled this call for 30 minutes, please bear with us if we run over by 10 to 15 minutes so we can cover these topics thoroughly for you. And now for the market update. The first half of the third quarter, returns were stronger than they were in the second half of the third quarter, as markets were recovering from the Brexit shock of June. The other interesting thing about the third quarter was that what worked well in the first half of the year worked less well, and what didn't work well in the first half of the year worked very well in the third quarter. As you can see from the chart, the NASDAQ composite was up over 10% in the third quarter. So year to date, as of September 30th, it was up 7.15%, and it doesn't take a math genius to figure out that on 6/30 it was actually down for the year. Also, the Russell 2000 was up 9% for the quarter and was only up 2 and change for the year as of the first half of the year. Emerging markets were up 9%, as you can see, 16% year to date. They were strong both in the first half of the year and the third quarter, but had been recovering really from 3 dismal years in terms of returns in the equity emerging market space. High yield bonds continued their strong run throughout the year, making 5.5% in the third quarter, 15% year to date. The theme, as you can see here, is that things that are particularly considered riskier did better than things that are considered less risky or have less volatility, which is the opposite of what happened in the first half of the year. In the first half of the year, generally what's called low volatility stocks, things like consumer staples, utilities, did much better than higher volatility stocks. That reversed itself in the third quarter. And you can see NAREIT equities are REITs, which are real estate investment trusts, paying a high dividend. That actually lost money in the third quarter. And high dividend paying stocks were the best performer generally in the first half of the year, as you can see by the year-to-date return on REIT equities of 12.3%. Please excuse the fire engines in the background. There's nothing we can do about it. It's just going by our window, so we apologize for that. Let's move on. Year-to-date, this is a chart of the S&P, and the S&P is up about 7.8% through 9/30 and was up 3.85% in the quarter. As you can see, this is a year-to-date chart. We've recovered substantially from our February lows, right between the F and the M on the left hand of your screen. But recently, we've been going sideways. That light blue line is the 50-day moving average, and we have not crossed that. This is not a chart that would incite fear, but it's certainly not a chart that would incite a feeling of raging bullishness. And if we look at the bottom part of the chart, those green and red lines, that is something that we use to analyze the potential of the markets other than pure price. And so the S&P is market cap weighted. In other words, the largest stocks constitute a more important part of the index, a larger weight in the index than smaller stocks. The breadth indicator does such things as minimize the market cap influence of the S&P. It also takes into consideration numerous other factors like volume and the number of stocks that go up versus the number of stocks that go down. This breadth indicator is negative, but the market is really sideways, range bound, and has been that way. This is the EFI, and what the EFI is, it's the international stocks, not in developed international stocks. So it's Europe, it is Australia, and it is the developed Far East. So it would include, for example, Japan. It would not include Thailand. It would include Western Europe, would not include certain Eastern European countries that are considered emerging markets. This is also off its lows. It has a chart that is slightly better looking than the US chart, but still there's several resistance areas, and it's not a terribly bullish chart either. One of the things, of course, that happened prior to the third quarter was the Brexit vote, and the Brexit vote had a very interesting implications for both the British pound and the British stock market. Now here we have two lines. The red line is the FTSE, which is essentially the equivalent to the US S&P. It's the largest British stocks, and that's the red line, and the blue line is the pound. So what has happened since the Brexit vote, and you can see that dramatic decrease on the blue line, confidence in Britain's economic system really declined, and that's evident by the pound falling significantly in value to lows that we haven't seen in decades against the dollar. However, the stock market ran. Now, why would that be? That would be in large part because even though people were concerned about Great Britain, a lot of British companies, the great majority of British companies, do business, significant amount of business outside of Great Britain. And with the pound being cheaper, their goods are cheaper. They're cheaper for foreign countries to buy those goods, foreign purchasers to buy those goods. And so the feeling was with the declining pound, international stocks, large stocks in Britain that sold to the world, would do better. So even though this seems counterintuitive, when you think it through, it makes sense. This is the chart of emerging markets, and as I mentioned before, emerging markets significantly underperformed the developed markets over the last several years. This chart is the best looking chart of the three being the S&P and the EFI chart, but has also traded range bound recently. Now to valuations, and this is the price to earnings ratio of the S&P 500. The dotted line is the historical average for that period from 91 to date, and you can see that we are slightly overvalued 91 to date, given the average of 91 to date right now. We could go significantly more overvalued, of course, as we did in 98, 99, but it is not cheap at the current time. This is small cap valuations, and they are probably even slightly more richly valued than the S&P, above their historical averages. And EM, which was undervalued for quite a period of time, has now also crossed that average valuation line, although less so than the other two indices. And finally, this is high yield spreads. And what a high yield spread is it's the average cost of a high yield bond, a bond for a risky company, a company not in bankruptcy, but not investment grade. Sprint, for example, would be an example of a high yield bond. This is the spread, how much you have to pay above treasuries, which is considered the risk-free rate. And when spreads are tight, high yield stock is expensive. When spreads are tight, high yield bonds are expensive. And here spreads are tight at 458 over their historical average. We can see in February when everyone was concerned about energy and defaults in the energy space, spreads were very high, prices were cheap. Now prices are more expensive as energy has recovered some of its footing. Part of this is that energy defaults in energy companies are less likely to be tremendously widespread. There still will be some, but it won't be as widespread as the predictions were in February. The bottom line with those charts is nothing is a screaming buy right now. Valuations are rich. They're not as rich as they have been at other periods historically, but there aren't any great bargains out there. Some of the reason for this, of course, has been the continued activity of central banks and their intervention in markets to essentially prop markets up. ECB is the European Central Bank. We have shown charts like this on a few of our calls. They are buying bonds. They are not only buying corporate bonds, they are buying government bonds. And this is a chart of the European Central Bank's purchases of bonds. And you can see they are up to $1 trillion worth of bonds, remarkably. When you have someone in the market buying like that, it keeps prices low. It keeps prices high.
Yields.
Yes, yields low, prices high. Thank you, Darren. Negative yielding bonds. This is also the result, is yields low, prices high, as Darren said. There's $8.5 trillion of negative yielding bonds. In other words, you are paying them to lend them money. You lend them and you have to pay them. It's remarkable, and I don't think there's been a period, I guess in the immediate post-war period, post-World War II period, there were some negative yielding bonds, but not like this and not since that time. It is truly a remarkable thing of central bank intervention. And what's equally as remarkable is what's happened in Japan. BOJ is the Bank of Japan, and that's the Japanese central bank, the equivalent of our Fed. Unlike the European Bank and the US Central Bank, the Japanese central bank is actually buying equities. They are buying ETFs. And the right-hand chart shows you that the Bank of Japan owns 55% of all the outstanding ETFs in Japan. The left-hand chart shows you that the BOJ is the top 10 shareholders in 90% of the Nikkei 225. The Nikkei 225 is essentially our equivalent of the Dow Jones. They own 90% of the Japanese index. Think about how hard that makes it if you are a value investor in Japan investing on fundamentals. Now, as I mentioned, what worked in the first half did not so much work in the third quarter, and the utilities index is a great example of that. In the first half of the year, because you saw negative bonds, ECB bond buying, we had a lid on rates in the US market as well. And there was what has been known as a search for yield, people looking for yield anywhere. And there were certain equities that actually became bond substitutes. People were buying them for the yield. And utilities were one of those. And they were one of the best performing investments for the first half of the year. This reversed in the third quarter, and you can see in the purple line, utilities sold off significantly in the second half of the quarter. The same is true for REITs. We talked about REITs earlier. They are high, they pay a high dividend, and they also fell off significantly. Oil stabilized and was range bound between the $40 and $50 range, and as I mentioned, that partially explained the compression of spreads, lowering yields in the high yield market because high yield market has significant exposure to energy, and this range bound reassured markets to some extent. From a fundamental perspective, the economy still looks pretty good. LEI are the leading economic indicators. They are the indicators that predict how the market's going to perform in the future. CEI is the coincident economic indicators. They are the indicators that measure how the economy is doing right now. They're both still favorable. We can see, though, that the slope on the LEI curve is flattening to some extent, and there are a few warning signs in sight. One of those warning signs is retail sales. We actually recently had a strong retail sales number, but in the third quarter we didn't, and retail sales have been continuing to decline. The other warning sign has been operating earnings for the S&P 500. And operating earnings are, as the name implies, earnings from operations. So you don't get depreciation thrown in or one-time sales of buildings thrown in. These are what's the ongoing business doing? And we've seen a recent uptick in operating earnings here, but we've seen some steady declines over the last 18 months in operating earnings, which has been a concern. And that goes along with a long-term chart that is going to begin my segue into Darren's election update, which is GDP growth. And as we can see from this chart, this is quarter by quarter GDP growth going back to the 80s. And the line is just, if you just draw a line over those peaks, it's just a steady downward decline. There's one famous economist, Larry Summers, who calls this secular stagnation. I don't want to go into the details of what that means, and it is somewhat controversial in terms of the way he presents it, but there is no doubt that over the last 5 or 6 years, we have had a significant difficulty restoring the old growth rates that occurred pre-2008. And the final chart I want to show you is has gotten the nickname the elephant chart. And I think if I had to pick one chart that summarizes the macroeconomic implications of what's happened over the past 20 years, this would be the chart. What this chart shows you is this is global income distribution. So the 15 in the bottom horizontal axis, that's the 15th percentile of people around the globe based on income. The 95th percentile is 95th percentile around the globe in income. So you can see enormous income gains, really historically unprecedented income gains around the world between the 15th and 65th percentile. And when you think of the 15th to 65th percentile, you're thinking emerging markets, and you're seeing a rise out of dire poverty that we've never really seen before. You've 60, 70, 80% growth rates in those economies. However, the 75th to the 95th percentile, or really to the 90th percentile, has had a much more difficult time in terms of growth over the past 20 years, and that really represents the middle class, working class of the developed markets, the US, Europe, and Japan. And of course, the wealthy, the 95th percentile and up, have done well. Not as well as the poor in the emerging markets, but well enough. Now, the explanations for this in terms of how much that has to do with trade versus technology is a political debate that we're not really prepared to get into, but I think this chart gives you a very good sense of the reasons behind some of the nationalist movements such as Brexit that have occurred in the developed world. And now I will turn it over to my colleague Darren Ritchie to give you the election update and comments on reinsurance.
Thank you, Howard. We'd like to present a quick overview of where we see the election playing out, the investment implications of that, and then again we'll segue on to our special topic for the call, which is reinsurance. So one resource that we look at fairly closely in terms of gauging the state of the election is the 538.com website. You may be familiar with that. It's run by Nate Silver, who's a noted statistician. And I think they produce probably the most sophisticated analysis of where the election is based on polling data. So what we pulled up here is this morning's update of their presidential election victory odds. These are not vote shares. This is the odds of each candidate winning the electoral vote and therefore securing the presidency. Currently this morning they have Hillary Clinton at about an 85% odds of winning, with Trump at 15%, and third-party candidates like Gary Johnson, Jill Stein at essentially 0% in the current state of the race. And we've seen obviously volatility over the course of the last several months in the presidential election. It of course tightened in late July, early August, but Hillary Clinton at the current moment in time seems to have established a fairly significant lead. Currently, their simulations of her popular vote margin are around 6%, which translates again into about an 85% chance of winning. If we advance to their current projection of the electoral map, we see Hillary Clinton again in command of most of the swing states and even making some inroads into traditionally Republican states like Arizona, which is currently essentially a toss-up. There's also some interesting dynamics out of Utah where a third-party conservative candidate is rising quickly in the polls, and he may actually be able to secure a victory, which would be the first time an independent candidate has won an electoral vote since the 1960s. So the electoral map is a little bit scrambled, but currently at the moment, again, a comfortable margin for Hillary Clinton, barring some unexpected development in the race. We're also paying a lot of attention to the congressional elections. I think this is an area that is getting less attention than it probably deserves based on the focus on the circus on the presidential side. Currently, this is a tighter picture, has seen more volatility. The Democrats in the last month or so have created a bit of margin for themselves in the Senate projections. Again, these are from 538's current modeling. About a 2/3 odds that Democrats will take control of the Senate, about a 1/3 probability that the Republicans keep control. A 50-50 Senate is actually a relatively likely outcome. In that case, the winner of the presidential election would determine control of the Senate because in a tie situation, the vice president would cast a tie-breaking vote. So there is actually a reasonable correlation between the Senate odds and the presidential odds for that reason. So what are the investment implications of this case? Currently, given the state of the race, the market should be anticipating and pricing in a Hillary Clinton victory. A Trump recovery at this stage in the race is essentially not paralleled by history. This has been a very unusual election, so we can't rule anything out, but it would be quite unusual for him to recover the sort of deficit that he finds himself in at the moment. Given that, we believe that if the Republicans are able to maintain control of the House of Representatives, which is considered quite likely at the moment, not a certainty, but very likely, we're essentially in a status quo situation where we have divided government and that any legislation that gets passed would have to represent a compromise between the Democratic administration and at least one House of Congress in Republican control. We think the market would probably react quite well to this sort of status quo outcome. On the other hand, if we get some unexpected event, such as either a Trump victory or a Democratic sweep where the Democrats not only win the presidency and take control of the Senate, if they exceed expectations and win the House, giving them unified control of the government, that could also create uncertainty in terms of new tax policy, new regulatory policy, other policy changes that might be less friendly to financial markets. So we're watching those outcomes, but currently we believe that if things play out as they stand today, we do not expect major market reaction from the election. And frankly, historically, elections have not been major determinants of financial market performance, aside from a few very outlier outcomes, for example, like the Brexit vote. Some sectors to watch that we're keeping an eye on based on the outcome. Things like financial stocks and pharmaceuticals, medical device manufacturers could be impacted in a Hillary Clinton victory scenario where there might be pressure to, for example, break up the large banks, impose new price controls or regulations on drug manufacturers to address drug price increases. On the other hand, if Trump were to win and try to aggressively renegotiate some of our trade deals, that could put pressure on major U.S. exporters. For example, if China gets their back up and decides that their airlines are going to buy Airbus instead of Boeing, they're going to buy Siemens MRI machines instead of GE MRI machines, you could have some impact on U.S. exporters. So those are sectors we're paying attention to, but at the moment we do not see broad investment-related consequences from the election at the current time. So with that, we'd like to transition to an update on reinsurance. And the reason we're focusing on reinsurance in the current call is, for one thing, it's a bit of a different animal in many client portfolios. It doesn't have a lot to do with traditional stocks and bonds, and so it may be less familiar to many of our clients as an investment. The other reason we wanted to highlight it is that we expect to break this out as a separate asset class on client reporting beginning next year. That is probably going to happen. So you'll see a new line item on your statement labeled reinsurance. And to try and get you educated before that occurs, we wanted to highlight what it is and why we're investing in this asset class. So we'll start with what is reinsurance. as the name may suggest, it is essentially insurance for insurers. So, for example, if a major insurance company like an Allstate or a Geico or a PEMCO insures homes and businesses in a community, they assume that liability, that risk for various events that might happen, like house fires or burglaries or earthquakes. They assume that risk in exchange for a premium that you pay the insurance company, which I've represented with the building here in the middle. They can plan for most of those sorts of events, and they can reserve capital if they need to pay out a claim. If somebody breaks into your house and steals your TV, or if your laundry or your washing machine floods and you need to replace your drywall, your insurance company would cover that. They have more trouble covering risks that occur to all of their policies simultaneously. In those cases, diversification, which is what they really lean on to make their business model work, doesn't help you. If you get a Category 5 hurricane in Florida and every single house in Florida needs a new roof at the same time, that's much harder for an insurer to deal with. So what they will do for those major risks is they will decide how much risk they want to retain, and then they will go to a reinsurer to assume that extra risk that they do not want to carry on their own books. So reinsurers take this excess of liability or excess of risk from insurers on various risk categories around the world and assume that for them. So major perils or risk factors covered by reinsurance are typically, again, areas where you have major risk factors that are going to impact a large portion of insured property at the same time. Things like hurricanes, earthquakes, straight-line windstorms like nor'easters in the New England region, tornadoes. Hailstorms are maybe an underappreciated risk. A severe hailstorm can do hundreds of millions of dollars worth of damage to building glass, to automobiles, and so on, even agricultural areas. And then there are also some new areas that are increasingly being tapped by reinsurance, including wildfires, cybersecurity, and other forms of security intrusions. Even meteor impact has been a risk factor that reinsurance has been covering lately. However, on the right side, we see flood. Flood is typically not covered by reinsurance for the reason that most residential property flood risk is not covered by private insurers. Most flood coverage is provided by the Federal Emergency Management Agency, FEMA, not by private actors. There is some commercial flood insurance that could find its way into reinsurance portfolios, but when we talk about reinsurance, flood risk is typically not a major part of those portfolios. And even in a case like a hurricane storm surge, when we talk about hurricane risk, we're really talking about wind damage, not about flood or storm surge damage. So how do we participate in reinsurance as investors, which many of us do? There are really two ways that we can do this. The first is through instruments called catastrophe bonds. The name sounds scary, but we'll see that they function in a fairly parallel way to a more traditional corporate bond. In this case, an insurer, let's call it PEMCO, a local company, decides that they want to get rid of some of their excess risks that they do not want to assume. So we'll have them issue an earthquake catastrophe bond, which is definitely a risk that we face in the Pacific Northwest here. So they're going to issue this earthquake catastrophe bond to the general public, which I've illustrated on the right. Could be pension funds, insurance companies, mutual funds, and so on. When they do that, the public buys the bond from the insurer, again linked to an earthquake risk, but the insurer doesn't get to keep that money for their own usage. They can't use it to spruce up their offices or buy a new fleet of trucks. They have to escrow that money away in case it's needed to pay claims. So you're not taking risks that PEMCO is going to go and do something foolish with the money. It has to be squirreled away essentially to address that specific risk that the bond covers. Now, in exchange for assuming that risk, you as the catastrophe bond investor are going to get an insurance premium, which is related to the risk that you're assuming. What sort of earthquake are we anticipating here? And typically, again, these are covering major severe disasters with a relatively low probability of occurrence. We're not talking about a 3 or 4 or 5 magnitude earthquake that might do a fairly minor amount of damage. So assuming that the event does not occur, there is no earthquake, you collect your premium. The bonds tend to mature in a year or two, so they're fairly short duration bonds. If that occurs, they return your principal and we go on our way. However, if we do get the event, an earthquake occurs, let's say that earthquake is of sufficient magnitude that the bond essentially is cut in half. So investors will lose half of their principal in that event. They keep the premium they've already earned, but they will not get their full principal back. That half of your principal is used to pay out claims. So the risk that you're taking in a catastrophe bond is essentially tied to that particular risk occurring. There are not other risk factors that are associated with traditional bonds, which I'll get into in a moment. So that's one instrument. Catastrophe bonds are securities. They trade on exchanges. We can observe their market prices, and so they are a fairly transparent way to participate in reinsurance. The other vehicle that we use to access reinsurance is a different instrument called a quota share. And a quota share occurs when we participate alongside a more traditional reinsurer, like a Berkshire Hathaway or a Swiss Re or a Munich Re. The way this works is that reinsurers, again, being the traditional providers of this service to insurance companies, underwrite a variety of risks, including things that we've talked about like earthquake, hurricane, windstorm, tornado. They also underwrite other risk factors for which there are no catastrophe bonds. So this gives you a more diversified portfolio of different kinds of risks, including aviation, marine and shipping insurance, agricultural insurance, even fine art. If the Mona Lisa burns down in a fire, heaven forbid, somebody will have to pay an insurance policy to the Louvre on that piece of artwork. So it includes a variety of risk factors. And the way that quota shares work is you get a slice of every risk in a reinsurer's portfolio. So they don't get to pick and choose which good risks they're going to keep for themselves and which bad risks they're going to assign to somebody else. We get a broad stripe of everything they do, and then we collect the premium for assuming those risks, and we suffer the potential of loss if one of those risks does occur. The quota share market is a direct contract between the investor and the reinsurer, so it is less liquid. It is not a security, it's a contract, which is a potential drawback if liquidity is a concern. So what are the investment characteristics of reinsurance? As we mentioned, you're essentially not taking credit or interest rate risk, which are the two major risks associated with traditional bonds like municipal or corporate bonds. Because those losses only occur when the specified event happens, it's pure event risk. Does a hurricane occur? Does an earthquake occur? Does a windstorm occur? And the great thing about those events, although they're disasters for the underlying people, from an investment perspective, they have no correlation to traditional stocks and bonds. They don't care what the S&P 500 did. They don't care whether the Fed raises or lowers interest rates. Again, they're purely dependent on the statistical probability of a disaster occurring. In terms of drawbacks, as we mentioned, quota shares in particular are less liquid. They're not an exchange-traded security. Even the catastrophe bond market, which is a traded bond market, it's a relatively small market compared to other types of bonds, and could become less liquid in specific market stress scenarios. We haven't observed it at the current time. Catastrophe bonds are actually in fairly high demand at the moment, but these are potential risks that we bear in mind when constructing client portfolios. Turning briefly to performance, there is an index of catastrophe bonds that goes back to the early 1990s. We have Bloomberg data on it from 2003, and looking at it year to year, we can see relatively consistent performance, especially compared to a more risky asset like the S&P 500. So even in a fairly bad year like 2005, when we had Hurricane Katrina causing massive losses and several other severe hurricanes like Rita and Wilma as well, the cat bond index was actually positive. It managed to eke out a 1.6% return. 2011 was another severe year for global disasters. You had the Japanese earthquake and tsunami, the nuclear meltdown. You had another major earthquake in Christchurch, New Zealand that devastated Christchurch that year. Again, you ended up with a modest but positive total return in that scenario. Versus an index like the Barclays Aggregate Bond, similar level of returns of volatility over time, but much better returns from cat bonds. If we look at the right side of the lower table, the rate of return column, ROR, is the compound annual return on each of those indices over that period from 2003 onward to present. You can see the cat bonds have earned nearly 8% on average, far in excess of the Barclays Aggregate Bond Index at 4.5%, and nearly as high as the S&P 500. So you've made almost as much from cat bonds as you have from stocks over this period. If we go to the far right column, volatility, this is the standard deviation of each of those measures, which is a statistical measure of how much they fluctuate. Cat bonds over this period were the least risky investment, 2.5% volatility, lower even than an aggregate bond index, and much, much lower than the S&P 500 at nearly 17. So over this period, cat bonds have been a fantastic investment in terms of the risk-return trade-off. Of course, past performance is not future return, and so we take a look at this on a forward-looking basis. We still think cat bonds, even though reinsurance rates have come down a little bit, still represent very good value in the current compressed yield environment that we find ourselves in today. In terms of the specific funds that we use that many of our clients are invested in, that we're actually personally invested in here at Coldstream, two of them that I wanted to highlight, both run by our partners at Stonebridge. The Stonebridge Risk Premium Fund is a mostly cat bond fund, so it is tracking fairly closely the orange dotted line with the Swiss Re Global Cat Bond Index that we talked about in the last slide. You can see that the orange line and the white line are tracking fairly closely together, which they're intended to do. The interval fund, the yellow dotted line, has more of an allocation to the quota shares that we described, which are higher risk, higher return, but more diversified baskets that we obtain in partnership with traditional reinsurers that include those other risk categories like aviation and marine. We can see that that fund has outperformed, but it's experienced more volatility, again in line with our expectations for the more volatile quota shares at the current time. And if you look at the very right-hand side of that chart in September, going out of September, we see a little blip, a little hiccup. That is an interesting fact and one that caused us to talk about reinsurance today, which was Hurricane Matthew, which happened at the beginning of the month. And this is a blow-up of the Stonebridge Interval Fund chart over the last year or so. And you can see, again, a major correction and then a quick recovery at the right side of the chart. Well, what happened here? What happened was Hurricane Matthew again. And early in the month, as that storm was developing down in the Caribbean, some forecast models showed it developing into a Category 4 hurricane that was going to not quite impact Florida, but brush up the coast of Florida and then stay right along the east coast of the U.S. all the way up through South Carolina, North Carolina, and eventually find its way possibly into New England, Massachusetts, Rhode Island, and then into Atlantic Canada potentially. So even though the storm didn't directly impact Florida, the projections were for serious damage all along the eastern seaboard that could have resulted in very substantial losses to catastrophe bonds and some of these other reinsurance instruments that we invest in. Those are largely priced by these sort of models about potential losses, and so we saw the funds react even in advance of the actual damage occurring as they anticipated based on, again, forecasting models that this storm could result in a very serious impact to the east coast of the U.S. Fortunately, this did not come to pass. The hurricane was somewhat weaker than expected, and even more importantly, it stayed further offshore of Florida, and it did not curve up into the rest of the East Coast. It stayed further east and eventually dissipated off the coast of Florida. So most of that damage that was anticipated did not come to pass, and therefore the reinsurance funds recovered very quickly from that temporary drawdown. What this does show us, though, is that reinsurance is not a risk-free or even a low-risk investment. And therefore we can't assume that there will never be losses in these products, but what we do like about them is that they are not correlated risk. They don't tend to move along with stocks and bonds, and so for that reason we think they're very powerful diversifiers for client portfolios. For a typical client portfolio, reinsurance will make up anywhere from 5 to 7% of a typical risk allocation. But given that all of our portfolios are customized, your personal allocation to reinsurance would be determined in consultation with your portfolio manager and your relationship manager. So if you'd like to discuss this in more detail, please contact your RM or PM or simply bring it up at your next client review meeting. We do think it's one of the more interesting areas where Coldstream has access to and that we can add value to client portfolios through these sort of uncorrelated investments.
Thank you, Darren. We've had two questions. I know we've run over in time, but we'll try to address them very briefly right now. The first question is asks us, Darren, to comment on the duration of the current bull market, and is that worth considering? I'll take a crack, and you can. It is, and please add on or interrupt. It is a long bull market. It's the second longest that we've had for quite a long period of time. It is something worth considering. However, bull markets don't end because of old age. They end because of some event that occurs. And so the fact that it's long makes you think the odds are that some event may occur in the future, but they simply do not end on their own because of time.
I'd agree with that. And if you asked me where we are in the stage of this expansion, we're probably in the 7th or 8th inning. We don't think we're in the 9th inning in terms of the economic data that we look at. We don't see, going back to the leading economic index chart that Howard talked about earlier, that chart is flattening out, but it's been a very reliable indicator of recession, and it's not showing the sort of warning signs that we would expect with imminent recession. On the other hand, we do know that this expansion is getting long in the tooth on a time frame basis, and the fact that security valuations, both on the equity and the bond side, are elevated. We don't think they're extraordinarily high, but they're elevated at this point in time, so we don't have a lot of cushion in case there is a disruption. So we're not alarmed yet, but we are cautious, and we are definitely thinking about those issues as we allocate.
Yeah, and just to add to that, back to the point I was making earlier, is the central banks have had a very strong interest in supporting this market and maintaining it as part of the economic recovery. I think they are recognizing that incremental activity is showing less and less results. So we think that that over time will be curtailed. It's certainly going to be curtailed quicker in the US than Europe and Japan, but will be curtailed there as well. And that will also be something we'll need to pay close attention to in regard to whether markets roll over or not. The second question is a political one. If Trump wins, he says he'll end, quote, pay to play. If banks cannot buy influence, how will that impact the market? So let me just start on that. I just have to say I'm not sure of what Trump means by pay to play. There are pay to play rules currently that strongly prohibit, for example, the contributions you can give to any government decision maker who is involved in allocating assets. So Coldstream could not give money to a pension plan person, for example. If pay-to-play means contributions to Congress, I think there is pretty close, especially in the Senate, of a scrutinizing eye on banks right now. So with the caveat that I'm not sure what he means, I think there are other issues that both Trump and Clinton support that would have bigger influences on the market than that.
I agree.
Yeah.
We had one other quick question on reinsurance, which is whether reinsurance includes other risks such as health factors that we're seeing with the premium increases in the health insurance market. The answer is really no. Reinsurance revolves around property and casualty insurance, which is property damage. There are some reinsurance risks called excess of mortality, which is essentially the risk that people live too long or die too soon. Those are really related to things like pandemics. That's not a big part of the reinsurance market. It does exist, but really is not connected to any of the health insurance issues that we're seeing currently.
So thank you very much for your attention and for staying with us beyond the 30 minutes. We hope you found this call informative, and we will see you next quarter.